strategy of the fund has been fairly consistent, for the last 5 years. The focus was always on companies that were well capitalized. So, we typically don't do bridge deals. We don't do distressed investing. So the way I'd like to classify it is performing companies. We were always focused a little bit more towards early growth and growth stage. And I think as we've grown the business, our bias has shifted even a little bit more towards Series B and beyond. I think what we've learned from the last 5 years is that, even at a Series A, potentially there could be headwinds, for companies. So really sort of the right point of entry from a venture debt fund to truly have the risk profile be different from venture equity is around a Series B, because by that time, the unit economics are a lot clearer. The competitive landscape is possibly clearer. Some of the questions around regulation are behind you. So if we sort of apply some of those filters, as companies get to being 3 to 5 years old, having raised a couple of rounds of funding, the team is well built out, that's the right time for us to get involved. Because otherwise you end up taking venture capital like risk and not getting paid the same, right? So fundamentally, we really do want to draw a line around saying what is concept risk and what is execution risk. And we are most comfortable taking execution risk. So on a cumulative basis, we've now deployed almost 1,700 crores of venture debt in the last 5 years. We have 5 unicorns in the portfolio. We have multiple soonicorns in the portfolio. And it's not by chance. I'd say the attention for us is shifting into where the VC money has gone in the last 2-3 years, is sort of the narrative around either build for Bharat, so companies that are going after the next few hundred million, as well as some SaaS opportunities, because we're increasingly seeing investors keen to look at pure technology and enterprise software. So I'd say those are the 2 areas where you'll see us following the money and riding out these sectors as they continue to grow. So while we are not a substitute for equity, I think as these companies grow, the fact is their working capital requirements grow, their inventory taking requirements grow, their CapEx grows, sometimes they need to fund an acquisition. So the use cases keep evolving. And, in a case of somebody like a BigBasket, we've probably done cumulatively about 150 crores of credit to BigBasket over the last 4 years. Now, they used our money to fund working capital. They used our money to fund cold chain. They used it to fund supply chain. And that ended up protecting a lot of dilution for the founders as well. It probably has not shaped our funnel too much right now, but as it relates to many of our portfolio companies, whether it's a Vedantu or a QMath or a Pharmeasy or a BigBasket or even a Ninjacart for that matter, the tailwinds of COVID have been very significant. And I would imagine that it's probably advanced their businesses by anywhere between 12 to 24 months in terms of penetration levels, growth rates, and things like that. So, back in March, April, there was a lot of uncertainty and fear. By May, things were starting to get clearer, particularly for these kinds of companies. And by June, there was a lot of fire and heat around these companies because they were just growing like rocket ships, right? And I think, in the last 5 months, we have deployed 200 crores in venture debt into the market, right? Across, I think, 15 new investments, of which about half were existing companies where we put more money along with rounds, and half were completely new investments. Cumulatively, like I said, between Fund 1 and Fund 2, we've done already 1,700 crores of credit in the last 5 years. So we're fully drawn and recycled on Fund 1. We're actually returning capital to investors and returning income to investors. In Fund 2, we've drawn quite substantially to this point, but we have one more cycle of recycling to do with our second fund. So I believe that, probably given the pace that we're deploying at, we would probably raise Fund 3 sometime towards the middle of next year. So I would say, probably staying in that 1,000-1,200 crore range is a more efficient way of managing even some of the ALM, because we keep getting money back from portfolio companies and you have to reinvest that. So I think at this point, staying in the same zone of fund size probably allows us to be very disciplined on the kinds of companies we're investing in. But the truth was that as we were spending more time with companies, for many of the CFOs in these companies, it was a significant challenge to actually do cash flow planning and to manage the asset allocation, because they were constantly raising capital, because many of these CFOs really are great financial controllers, but they don't have a lot of experience in managing these large pools of money, right? Our companies are raising 50, 100 million rounds of financing. So we said, why don't we simplify your life? Let us give you a custom built platform. Log into a Trifecta branded interface. Within that interface, there are, guardrails, which says, look, given the charter of the company and what is agreed with the board, these are the set of instruments that you can invest into. It includes, FDs from banks. It includes fixed income funds. It includes corporate paper. And, any other instrument that the board allows the company to make an investment into. We also sit down with them and do their cash flow planning for the next 3, 6, 9, and 12 months. And then we suggest a allocation framework to make sure that the liquidity needs of the company are well looked after. I think the biggest difference between what we do and maybe what a traditional treasury provider does is we are not in the distribution business. So we do not get paid by the fund houses. We do not get paid by these entities whose products are on the platform. So we are completely aligned from a company's perspective, and we get paid for the technology and the advice that we provide to our companies on a percentage of the assets under management that we are helping them look after. This is now, an ongoing exercise where we provided the base platform, and every quarter or so, we're slowly adding in new features based on the feedback that we're getting from a CFO council that we've created. So we've also created a CFO council starting with 8 CFOs. Some are portfolio companies, some outside of our portfolio, to say, look, this is your workbench. And you tell us, where else you need help, right? And as they continue to give us input, we continue to develop new features. And so that, hopefully over the next 12, 24 months, this truly becomes sort of the center of gravity for the CFO. So we worked with a third-party provider to, customize the features that we needed. And now we continue to add. So the way I think about this as a platform is that we will also cherry-pick certain third-party integrations that we would like to make seamlessly available through an API to this platform. So as an example, the current platform did not include a dynamic discounting solution. So we identified a partner that could provide dynamic discounting, and we integrated that. So if you have a surplus of money in your treasury and you have, a bunch of payables to make, you can do a dynamic discounting program. I think it took about, 6 months or so to, I'd say about 3 months of requirements gathering, another 3 months of customization. And it's been live for about 6 or 7 months now. It's actually gone to this point where not only are VC-backed companies using the platform, 2 very large, very prominent VCs have now taken this on themselves, because they're saying, we also would like to understand our entire portfolio in the country. What is the underlying money sitting in? So, for existing portfolio relationships, of course, we have full visibility, into all the reporting they would typically provide us as a credit provider. And for companies that are not in our portfolio, what we're largely helping them with is managing their cash. So, of course, we get an understanding of the stock of money. We get an understanding of how much money they're consuming, but we are not privy to, business data in terms of, revenues and things like customers. And so that, that we don't get to see if it's not a portfolio company. And I'd say we continue to innovate on products. So, we used to have like a term product We've now added a line product. So typically the classic venture debt arrangement would be a 36-month loan, with monthly repayment. We recognize that the needs of companies are changing, and we added in like a line product. So we create a limit, companies can borrow and then repay a certain number of times in a finite period of time. So, it's adding a lot more flexibility to the use cases around which companies can deploy debt. So typically in sectors, say like agri, there's a lot of seasonality. And so companies want to draw and repay as opposed to servicing a traditional, term type of arrangement. Actually, we introduced it about 6 months ago, and we've got a couple of companies that have already taken advantage of it.